Welcome to the Make It Personal podcast presented by Mutual of Omaha Advisors. Make it personal. It's your money. It's your plan. It's your future.
We're now 13 episodes into this podcast, and the feedback's been great and informative as we continue to look for relevant topics for what people want to hear about. One interesting question I've received is, why do I stand during these podcasts? I stand, frankly, because I prefer not to sit. When we started, I was offered a chair, though I declined, wanting to make sure that you get my full energy with each episode. While I can admit that my legs can get tired from standing for multiple hours during filming sessions, I'm not being asked to stand against my will, so at some point, maybe I will take a seat. Otherwise, I appreciate the concern. Now on to our regularly scheduled program. There's a familiar saying that goes, "The only thing that is certain is death and taxes." The saying is commonly attributed to American statesman Benjamin Franklin. Taken from a letter to Jean-Baptiste Leroy in 1789, originally intended to refer to our newly ratified Constitution, but is particularly relevant to the United States system of taxation. The exact quote actually goes, "Our new Constitution is now established and has an appearance that promises permanency, but in this world, nothing can be said to be certain except death and taxes." While Franklin gets the credit, the earliest known version comes from a quotation from a play titled The Cobbler of Preston by Christopher Bullock in 1716. And I quote, "You lie, you are not sure, for I say, woman, it is impossible to be sure of anything but death and taxes." While Franklin was speaking of taxation in the late 1700s, it wasn't until actually 1861, during the Civil War, when the first federal income tax was created. It was a flat tax that was repealed in 1872. Income tax brackets, as we know them, didn't exist prior to 1913, with the ratification of the 16th Amendment and the passage of the 1913 Revenue Act. Most people agree that the current system is too complicated, yet almost every year the system gets more complex, not less. Why? Simplifying the tax code almost always conflicts with other policy goals. Congress loves to provide incentives to the tax code. Any problem we want to solve, let's use the tax code, and the result is that every year it gets more and more complex. For example, a stimulus bill could have hundreds of changes to the Internal Revenue Code, all designed to stimulate the economy, though they certainly complicate things. Which is why I relate more to what actor and social commentator Will Rogers said, in that the difference between death and taxes is death doesn't get worse every time Congress meets. I'll pause for a moment and introduce myself. My name is Mark Zagurski, and I'm the Director of Strategy and Communications for Mutual of Omaha Advisors, a division of Mutual of Omaha. For more than a century, we've been committed to listening to our customers and helping them through life's transitions by providing an array of insurance and financial products. I am here representing the voice of nearly 1,000 advisors across the nation. Don't worry, I'm not here to share my tax expertise. The corporate censors would love me to say, Mutual of Omaha representatives do not offer tax or legal advice. Always consult a qualified professional regarding your specific situation. Though I must acknowledge, a financial advisor certainly needs to take taxes into consideration with the planning they may do with you, in just the same manner that you need to take taxation into account when it comes to your planning. And now back to the story. Taxation without representation was the seed of the American Revolution. Colonists rebelled against Britain's punitive taxes because they had no voice in Parliament. On July 4th, 1776, the Declaration of Independence severed ties with England, the Revolutionary War ended in 1783, and a new nation was born. From there, arguably things have evolved and become more complicated when it comes to the federal tax system we know today. Okay, so let's turn the corner. What does all this have to do with personal finance? Well, the tie to taxes seems obvious. More directly, I'd like to discuss taxes in retirement. More specifically, what taxes do you pay in retirement? I could list federal and state income tax if applicable. I can mention sales tax and property tax. What I'd really like to dig into is income tax, specifically federal income tax. This is an area that's very often misunderstood and that at times is misrepresented, especially by what you might find from those vloggers and financial celebrities online. Not misrepresented as in intentionally false. Instead, often the examples are oversimplified and therefore do not provide an accurate picture. Let's take an example. Let's say you've accumulated $1 million in your 401k through your employer. According to an article on CNN.com, the number of so-called 401k millionaires reached an all-time high as of June 30th of 2024. The article was based on data released by Fidelity Investments, which based its conclusions on 24 million 401k accounts across the 26,000 employer-sponsored plans that they administer. To quote directly, as of June 30th, nearly 500,000 401k accounts, 497,000, had balances of $1 million or more, up 2.5% from the prior quarter. The average balance hit 1.595 million, up from 1.581 at the end of March, according to Fidelity's data. Awesome! More people are saving and becoming 401k millionaires. Congratulations! But what is that $1 million actually worth? Again, back to the various types of taxes. For our example, we're going to focus on federal income tax. The examples that I've seen and heard over 30 years in the business when it comes to how your 401k might be taxed always seem to have nice round numbers, 25%, 30%. The example might go something like this. You've got $1 million in your 401k that'll be fully taxable to you at retirement, assuming that it does not include any Roth 401k money. Roth 401ks or Roth IRAs will be a subject for an upcoming episode, so let's move on. Back to the example. You might be told if you're in the 30% tax bracket, your $1 million 401k is really worth $700,000 after taxes. 30% is a nice round number that makes for simple math, though frankly, today a 30% tax bracket for individuals doesn't exist in the tax code. And that's where having a better understanding of federal income taxes comes into play. Our federal individual income tax system currently has 7 tax rates ranging from 10% to 37%. You pay tax as a percentage of your income in layers called tax brackets. As your income goes up, the tax rate on the next layer of income is higher. When your income jumps into a higher tax bracket, you don't pay the higher rate on your entire income. You pay the higher rate only on the part that's in that new tax bracket. Over the 100+ years history of the modern federal income tax, started in 1913, the number of brackets and rates have changed dramatically and frequently. It began with 7 brackets, and that number exploded to more than 50 by 1920, and then in the late 1970s, there were fewer than 20 brackets. In 1986, the Tax Reform Act reduced the number of tax brackets from 16 to 2, and since then, that number has crept up to the current 7 brackets. The federal income tax rates are progressive, meaning that as taxable income increases, it's taxed at a higher rate. Though not every dollar is taxed at those higher rates, and that is the difference between what is called your marginal tax rate and your effective tax rate. Your marginal tax rate is the rate corresponding with the highest bracket your income falls into, or what level is your last dollar of income taxed at. Your effective tax rate is the actual percentage you pay on the entirety of your taxable income, taking into account the various brackets or rates that your income may be taxed at. So, with our $1 million 401k being taxed at 30%, that's worth $700,000, or so it may be portrayed. That is far from reality. First of all, you're not going to find a financial advisor worth their weight in anything that's going to suggest to you that the day you retire, you should cash in your $1 million 401k. That would cause you a huge tax liability in that year, and frankly, future tax liability depending on where you put that money if you cashed out that 401k. Instead, you're going to leverage your 401k and other assets to generate an income in retirement. Let's not cash out the full $1 million in our example. Instead, we withdraw $100,000. I fully get that this represents 10% of the total 401k balance, and I'm not advocating for this level or that this is an appropriate level. This is likely only an appropriate level for somebody who's looking to exhaust their 401k assets quickly and potentially outlive their money. I went with $100,000 just to keep it simple. In my situation, my federal filing status is married filing jointly, and I'm going to use the tax brackets associated with such based on what the IRS or Internal Revenue Service released for tax year 2025. I withdraw that $100,000. Conventional advice may tell me that I paid 30% taxes on it, meaning that it's worth $70,000 to me. The nature of our progressive federal tax system and taking into account our effective tax rates show us that it's actually worth much more to us after taxes. We'll take into account the standard federal deduction for married filing jointly of $30,200 in 2025, which at a basic level leaves us with about $70,000 of taxable income. In this simplified example, the first $23,850 of that income falls into the 10% marginal bracket, and anything up to the next $73,100 falls into the 12% marginal bracket. From the $70,000, $23,850 is taxed at 10%, and then the remaining $46,150 is taxed at 12%. This income level takes us into two marginal brackets of 10% and 12%. Our marginal tax rate is 12%, which is the percentage of tax applied to your last dollar of income. However, since we have income in both the 10% and the 12% marginal brackets, our effective tax rate, or the average rate of tax applied to our total income, is 7.92% in this scenario. A far cry from the 30% example that you may find out there on the interwebs. I fully accept that we're leaving many things off the table when it comes to the various taxes we may face in retirement. State income tax, sales tax, property tax, how our income tax level may impact the taxation of our Social Security benefits if we're eligible for them. Taking our effective rate of 7.92% into account, our $100,000 withdrawal is actually worth over $92,000 to us after taxes, only when taking federal income taxes into account. These numbers would change based on income level or withdrawal level. These numbers would change based on the different filing status, such as single, married filing separately, or head of household. We're not going to get into all those details today. Instead, back to where we started. What if we did cash in that $1 million 401k? What would our effective tax rate be then? Based on 2025 brackets and standard deductions, and taking federal income tax alone into account, our effective tax rate would be 28.30%, still less than the flat 30% that is often thrown around by so-called experts online. How are you concerned about the possibility of rising taxes in the future? Many of our gurus claim that you'll likely be in a lower tax bracket in retirement, while others believe that taxes will be higher due to mounting debt and unfunded government obligations. But how do they know what's true for you? Do you have a plan in place in case it isn't? What do we know about historical rates of federal income tax since 1913? The top marginal rate or tax bracket for individuals in 2025 is 37%. That's the highest rate that our last dollar of income can be taxed at. For comparison, in 1944, the top rate peaked at 94% on taxable income over $200,000, which is the equivalent of roughly $2.5 million of income in today's dollars. That's a high tax rate. Where do taxes go from here? Your guess is as good as mine, though you'll certainly find many opinions if you look for them online. Death and taxes may be certain, and I can most certainly say that our tax system is complicated. However, there are ways to make our tax situation better. There are a lot of places where people seek financial advice or guidance on personal finance. Social media and financial gurus tend to boilerplate and average everything. Regardless of what advice you see in viral videos or hear from gurus, you need a plan that works for you. The tax code is complex, and while you're working hard to provide for yourself and your loved ones, it can be challenging to research and implement the right tax planning strategies. The good news is that as you take stock of your personal finances, coming up with a plan to minimize the impact of taxation in your planning is solvable if you engage a financial advisor. Even financial advisors don't go it alone when it comes to legal and tax advice, as many have relationships with tax professionals and attorneys. If necessary, they can likely refer you to other professionals in your community as they help to design a customized financial plan replete with recommendations around investments and deductions. Although you'll have to pay a fee for the service, a tax professional can help ensure that you take every legal deduction and credit that you are due. It's never too late to create a plan to give yourself and your family financial security and freedom. What to do now? You can keep doing everything that you're doing that got you here where you are. That may be okay if you're confident that your current plan is going to help you achieve your future financial goals. Or take control of your future and schedule a no-obligation consultation with one of our advisors today. Even if you have a plan in place, would a second opinion from a financial advisor give you peace of mind? Go to www.makeitpersonalpodcast.com to schedule your no-obligation conversation with one of our advisors today and to learn more or download our ebook. Where do taxes go from here? I'm curious for your thoughts. Please feel free to leave a comment below. And while you're at it, please like and subscribe. Our mission, very simply, is to help our customers protect what they care about and achieve their financial goals. At Mutual of Omaha Advisors, we understand personal finance is personal, and financial well-being is essential to achieving your life's goals. Our vision is for every customer to be able to imagine, plan, and secure their financial futures. Make it personal. It's your money, it's your plan, it's your future.
This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. Mutual of Omaha Investor Services, Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Strategies discussed may not be suitable for everyone. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Mutual of Omaha Advisors is a division of Mutual of Omaha Insurance Company.